Well, welcome to it. Time to have a look at markets, looking at the Asian side of things, coming in mixed, and this is as investors digest China's GDP numbers that came in at 7% lower than expectations. Nonetheless, mainland Chinese markets higher. Hang Seng Index up 0.8%, with the Nikkei dropping 1.1% in negative territory. European stocks at this point looking very mixed, again, as investors on that particular side digest US inflation and UK inflation figures, as well as comments out of Fed Chair Jerome Powell from yesterday, as well as he continues his testimony today as well. When we look at US futures, it's the pace of global growth as well as the bond yields that have investors on that particular side worried. Locally here in South Africa, and we'll unpack that with our market watcher, we've got Tiger Brands providing an update with regards to how their operations were impacted by the unrest. Yesterday afternoon, we saw companies like Mr. Price, Famous Brands and Vukile Property Fund also giving us an update. But to talk about how all of this is affecting the markets, and especially those companies exposed to those riots, we are joined by our market watcher, Tato Mashiko, who's from Sanlam Private Wealth. Tato, thank you so much for your time. Let's have a quick check-in on the JSE at this point. How's it performing?
Good afternoon, Nastasia. Well, the markets are mixed, driven by local and global factors concurrently. You mentioned Chinese GDP data for Q2 coming out to 7.9%, slightly below consensus forecast of 8.1%. Not a significant miss. And on the positive side, retail sales numbers for June coming in at around 12%, similar figures for the previous months. And that is positive in the sense of consumer sentiment holding up in China, whilst on the fixed asset investment side, we are starting to see a slight slowdown. However, the government did reduce its reserve requirement ratio slightly, so perhaps credit extension will improve a little bit. And China is important at the moment because they were the first country to enter into lockdown last year, and so they were the first to begin the global recovery. And so people are watching to see when the slowdown in China occurs, because that will signal a slowdown perhaps to come in other parts of the world as well.
Let's talk about the rand. I mean, what is the impact and what are you seeing right now in a world where we're still dealing with COVID numbers that are increasing, a vaccination rollout plan that has been hampered, as well as these riots playing out? How's the rand looking at this point from your point of view?
Well, the rand's at around 14.5. And we've seen a massive sell-off over the course of the past 4 weeks, largely driven by global factors, investors switching into safe haven assets like gold and treasury bonds. And yields on treasury bonds have fallen to about 1.3% from a high of about 1.7% at the end of Q1. And that is mostly a reversal of an earlier trade, which was focused on optimism of global growth. Investors are now slightly cautious because of the emergence of the Delta variant, as well as a possibility of growth trend lines slowing slightly, which is why people have been watching China, and obviously they're going to be watching the US as well. So from that perspective, there's been a slight shift towards a more risk-off sentiment with the collapse in bond yields. That is very positive for sectors such as big tech, for example, and all long-duration assets in general. And as far as locally, obviously there have been local issues. And from an economic perspective, what's happened in KZN obviously speaks to infrastructure destruction, and that leads to obviously loss of earnings in the short term, as well as a cost to repair that infrastructure. Luckily, there are reinsurers, and SASRIA, which deals with this general rights insurance and destruction of public property, will obviously be looked at from a lot of businesses like the ones you mentioned in the retail sector, the production sector, to help in terms of claims. And we still have to see in terms of reinsurers, which local reinsurers and international reinsurers may be on the hook as far as that's concerned. So yes, that is definitely a concern in the short term. And we may see a spike in food inflation just based on supply issues in the short term. But going as far as the global view on South Africa at the moment, it's almost a wait-and-see approach. So one has to wait to see what happens with political response to what has been demonstrations, and how soon can the infrastructure be repaired, how will it be funded, and when will the province and other areas that have been affected go back to normal.
Right. So I mentioned that Standard Bank offering to buy the rest of the remaining shares of Liberty. Everyone on social media, especially the market watchers I follow, saying that it's a good fit. Do you agree?
I think it's a good purchase for Standard Bank. Obviously, it allows them to offer different products. Well, they do currently as well, but they want to benefit fully from an earnings perspective in the products that Liberty has to offer. Liberty, in terms of life insurance, focuses on the high income segments where they have historically dominated. There's also the standard JV where one can drive flows and management fees from investment products. And they have offered an over 30% premium to Liberty's close yesterday. So the deal at around 89.5 rands, a mix of cash and scrip. So Standard Bank will issue some shares, but it's only about a 3% dilution to Standard Bank shareholders. Most of the insurance companies were trading at a discount to embedded value. And so this deal in the long term is not really expensive for Standard Bank. It makes a lot of sense, especially if you believe in the bank insurance model. So from that perspective, it looks good. From the Liberty shareholder perspective, it's a friendly deal. Management seems to be on board, and they will have to decide whether or not they feel the current price relative to the embedded value and potential value of new business in future, whether they are getting a fair price for that potential growth. But the overall market in terms of insurance has obviously been under pressure over the past year in terms of lapses and surrenders of products, given the strain that people have been under. So perhaps it's an opportune time for Standard Bank to make this acquisition.
All right, Tato, thank you so much for your time. That is Tato Mashiko, who is a portfolio manager at Sanlam Private Wealth.